You are given for the ABC PLC company, source of capital is given bonds, preference shares, common stock. So cost of debt 11%, cost of preferred stock 13%, cost of equity, retained earnings and the new share issue 16 and 17%, and tax rate is 40%. And also we were provided this assumed total capital requirement of ABC PLC is 100,000 rupees. And its desired capital structure. So their capital structure, or they say optimal capital structure at the moment, or the based on the raising capital structure. I don't know whether we have time to discuss that one. So that is the say capital structure, total capital, how it how it included from the debt, equity, and the preference. That is we call capital structure. So optimal or the desired capital structure: 40% debt, 20% on preferred stock, 40% equity. So if using retained earnings first, using internal equity first, determine what is the weighted average cost of capital. So under the equity capital, it was given internal equity cost and the new stock issue cost. So just take the retained earnings part or internal equity first and calculate weighted average cost of capital. So you can use this information. These are the first information, and then these are the weights or the capital structure: 40 debt, 40 equity, 20% on preference shares. So just calculate weighted average cost of capital for the company using this formula. So weighted average cost of capital is equal. You have to use this information, right? 11%, 13, and 16. Tax rate is 40. So if I write here, so weighted average cost of capital, weighted average cost of capital is equal, say, cost of preferred stock 13%, weight on it 20%, weight is 20%, plus then cost of debt. So this is before tax cost of debt is given because tax rate is there. So before tax cost of debt is 11%. So this is you have to just for the tax sheet. So this is you have to multiply by 1 minus 40 tax rate. Weight for the debt capital 40%. Plus cost of equity. First you have to use this retained earnings first. So retained earnings cost is 16% into its weight. So this is weighted average cost of capital. For the ABC PLC, weighted average cost of capital or the cost of capital is 11.64. Yes. This is the weighted average cost of capital. If you know the cost of component capital and the weights, then you can calculate overall cost of capital of the company. You get it 11.64. Is 11.64. So this weighted average cost of capital is very important. It's a very, very important number for the financial manager, especially when you are evaluating an investment project. evaluating the investment, this cost of capital is your discount rate. Your discount rate to calculate the net present value. Based on the net present value, you may take the decision whether to accept or reject the particular investment. So when you calculate this net present value, the cost of capital is company cost of discount rate is company cost of capital. So this cost of capital, I am repeating it again. So this is the minimum required rate of return from our investment. So if you look at this one, you have raised capital using debt capital, equity capital, and preference shares. So by considering all holistically, the overall cost of capital of the company 11.64. So this ABC PLC company should secure at least this from their investment. Right? This actually it should be more than this. In order to create some value to the company, to create some value to the shareholders of the company, their investment should generate more than this. This is the minimum required rate of return that particular company should generate from their investment. This is the minimum required rate of return. Why we say this is minimum? At least if you can't earn this, you can't pay their expected rate of return. You can't pay their interest, their expected rate of return. You can't pay their preference shareholders' expected rate of return. In order to satisfy your investors, in order to pay their dividends, interest, capital gains, you should earn at least this. So that is why we call this as a minimum required rate of return from our investment of the company. So you can determine it like this. So this is the hurdle rate when you calculate IRR. Our next lesson, budgeting. So we are going to calculate NPV IRR. So after calculating IRR of the project, you should compare this IRR with the company cost of capital to take the decision. It based on the after-tax basis. So normally you know that tax impact. The tax impact has only on the debt capital. So this is based on the after-tax. So this is where the average cost of capital. This is very important number. Without knowing this, nothing can do by financial management. You should know what is our cost of capital. Right? So this is very important number. So you are given some example here. Using the following cost of capital information of the leader PLC, calculate its weighted average cost of capital. So you are given capital structure here. Their capital structure is given on market value. Normally remember, weights we calculate based on market value. You can calculate weight based on the balance sheet information even. That is on book value. It's particular base. But the next estimation is from market value. So normally cost of capital we calculate based on the market value weight. So you are given market value of the debt capital, market value of the preference shares, and market value of the equity capital. So how much their cost of capital? How much? Their weighted average cost of capital. You are given debt capital cost is given, preference share capital cost is given, equity capital is given without dividing internal external. So you are given equity capital as a general number. First, you have to identify their weights. Weight on debt capital, weight on equity, weight on preference shares. Total capital requirement here, 2 million. This is 2 million. From 2 million, 600,000 from debt. So how much is weight? 20. 30. This is 30. From 2 million, 1 million, you are getting from the equity, so that is 50. So then, preference shares, these are the weights. So now you can calculate weighted average cost of capital. Tax rate is given. So WACC is equal. Cost of debt, 19%. This is before tax basis. So you have adjusted for the tax. Weight on debt, 30. Cost of preference shares, 15%. Weight on it, 20%. Plus weight, cost of equity, 28%. Weight, 50. So this is the weighted average cost of capital. Is 24%. 24. 20.48. Weighted average cost of capital. Right, it is easy. So the next last point is marginal cost of capital. So now you calculate weighted average cost of capital using the company capital structure information based on the existing capital. Suppose now we are going to raise more capital for your investment. For your investment, you are needed some more capital. You have to have more equity or the more debt. So then you should be able to identify marginal cost of capital, or we call MCC. That is WACC. This is MCC. So what is the marginal cost of capital? You can see it is defined very clearly in the second bullet. It is the weighted average cost of capital of the next rupee of capital raised. We call marginal cost of capital. Suppose now in the previous example, in this one, now your total capital is 2 million. It is 2 million. Suppose you want to raise 1 rupee more. So you have to get from the debt or preference shares or equity. So then when your total capital is increasing by 1 rupee, what is the cost? What is the weighted average cost? If you have to raise more capital, what is the cost? So that is simply we call marginal cost of capital. Is the weighted average cost of capital of the next rupee of capital you raise. So that is very important, MCC, especially when you are evaluating the investment project. Suppose this company have feasible investment. So they need some money for this investing this particular investment. Suppose they are going to increase the debt capital. So then they are taking some more bank loans. So at new interest rate, currently they are taking additional bank loans, say 500,000 at a new interest rate. Now in this previous one, here cost of debt is 19%. In the existing capital 2 million. They need some 500,000 to invest in the extra project, in the extra investment. So they are raising this 500,000, say using bank loan. They are borrowing from the bank. Say here, interest rate is say 21%, not the 19%. That now cannot borrow at 19%. Now it is 21%. So then, what is the marginal cost of capital? It is the weighted average cost of capital of raising this new additional capital. So that is the MCC. That is the marginal cost of capital. So with that, you can identify marginal cost of capital as well as the break points, and also again you can calculate weighted average cost of capital. So conceptually, marginal cost of capital means if you are raising 1 rupee more, what is the relevant cost? You have to raise 1 rupee more, what is the relevant cost? So that is we call MCC. Right, now look at this. In this weighted average cost of capital line, I am going to the last line, right? Look at this one. Now here, this is total financial. This is weighted average cost of capital. Okay. So here you can see up to 100,000. Total capital requirement up to 100,000. The weighted average cost of capital is 11.64%. When your total capital requirement exceeds this 100,000, you can see there is a jumping break point. So your weighted average cost of capital is going to high level. So you can see this is as a break point. So your weighted average cost of capital line is coming like this up to 100. When the total capital requirement is increasing more than 100, there is a break point. So now new weighted average cost of capital is 12.04. This is NCC, right? So with the new cost of capital, suppose this is in the example it is there, right? I am going back after showing this diagram. So now when your total capital requirement exceeds this 100,000, so you can see there is a break point. So now this is the cost of raising additional capital. 100,000, 150,000, if you increase up to 150,000, so this is the marginal cost of capital, or this is the cost related to this new capital raise. So then again, you can consider by using the existing capital structure, and then now you raise capital, so you can calculate weighted average cost of capital. So this is the now new weighted average cost of capital. So likewise, in this weighted average cost of capital line, you will have number of break points. When the interest rate is changing, there will be a break point. When the cost of equity is changing, there will be a break point. So likewise, in the weighted average cost of capital line, there will be a break point like this. Many break points. When a break point is arise, you can work out MCC for that particular fund raising. This is some bit advanced area, but anyway, for the project evaluation, taking this marginal cost of capital is important. Then on this diagram, you can draw IRR schedule for the project. So then you can compare IRR with the MCC and you can evaluate the project. You can see which project you are accepting, which are rejecting. So likewise, you can evaluate. So that is actually the usability of this MCC and weighted average cost of capital. When you are doing the project evaluation, we come to what we call the IRR schedule. After projects, so we are drawing IRR schedule. So then you can compare this MCC and the internal rate of return. So all the projects above this MCC, you are accepting. All the projects below this MCC, likewise, you can evaluate. But anyway, we are not going to that level. Just we discussed, you should know what is this break point and how to determine that and how to determine MCC. That is your expectation. So let's go to the example and we'll come to here again. Look at this one. And this one. The company has now, in our same example, right? Here, this is the example. This one. This one. For this ABC PLC, Suppose that the available retained earnings of this company is 40,000 rupees. Same example, right? You may better to write down these numbers we require to calculate marginal cost of capital. We are using to understand the XCC, the same example. These are capital structure for the ABC PSC, cost of component capital. Then you are given additional information like this. Suppose that the retained earnings of the company is 40,000. The available retained earnings of the company is 40,000. Company available retained earnings 40,000. That weighted average cost of capital we calculated using retained earnings of 11.4. You calculated using retained earnings. Okay. 11.4 we calculate करेंगे. So you calculated it assuming first you are using retained earnings. This answer. 7.64. This is a weighted average cost of capital by taking retained earnings. For the equity to internal and external first for they are not supposed we use the internal equity. So using the internal equity, this is the bank. Now assume that your available retained earnings is 40,000. Is 40,000 to be used to finance the equity portion of this 100,000 to be raised. If you go to the previous slide, you can see their total capital requirement was the same example, right? $200,000. This is the total capital requirement is 100,000. Right? Total capital requirement is 100,000. So how they finance this 100,000? How they finance this 100,000? How they finance this 100,000? From the debt capital, 40,000. From the equity, using the equity part, 40,000 and 20,000 from the preference shares. Because this is the capital structure. 40 debt, 40 equity, 20 preference shares. So this 100,000 is their total capital requirement. This total capital requirement they have financed using this source of capital. Now you are given the available retained earnings of the company is 40,000. Available retained earnings of the company is 40,000. Since ABC desired capital structure for the common equity is 40%, you can identify, we call this is a break point, at which capital level the company required to issue new shares. So that is we call break point, right? So this is the break point. Break point is the amount of capital or the level of capital at which weighted average cost of capital is changed, which means that cost of one of the sources of capital is changed. Now here look at this example carefully. Their total capital requirement here the 100,000. So as far as total capital requirement is 100,000, this 40,000 is sufficient to recover the equity part. Because weight is 40%. Their capital structure 40% from the equity, 40% from the debt, 20% from the preference shares. So therefore no issue. If the company total capital requirement is 100,000, so this 40,000 is sufficient to cover the equity part, equity portion. Right. So, but you can identify what is the next break point. So 11.64 weighted average cost of capital you calculated using retained earnings. The official weighted average cost of capital 11.64 you calculated using retained earnings. This 11.64 weighted average cost of capital is changing when company is issuing new shares. I question asked. So at which point that company should have to issue new shares? That is we call break point. Break point, the amount of capital where the weighted average cost of capital is changed, or where the one component cost of capital is changed. So you can identify break point here using this formula. Break point is equal available retained earnings, or you can see available capital divided by percentage of total equity. Then make up equity at the you are using here equity. Suppose like this, say up to 500,000, you can borrow at 10%. When your loan total debt borrowing exceeds 500,000, your cost of borrowing is say 15%. So there is a break point. Up to 500,000, interest cost is 10%. The total borrowing when exceeding the 500,000, your cost of debt is 15%. So you can identify break point, available capital at this first level, 500,000, divide by weight on the debt capital. Now here, for your understanding, I am calculating break point using retained earnings. So available retained earnings here, 40,000. Available retained earnings here, 40,000. Weight on the equity capital. Retained earnings is equity, no? The weight on the equity capital in the capital structure, point. So your first break point will arise when your total capital is exceeding this point. Up to 100,000, you can manage with the 40,000. When your total capital requirement is exceeding 100,001, that's the break point. Right. Because මේ ලක්ෂ එකක් වෙනකොට total capital requirement එක රුපියලකින් වැඩි කරන්න උනොත් there is a break point because the retained earnings is not sufficient. In order to maintain the 40% equity level in the capital structure, you have to issue new shares. So then first break point will arise with this retained earnings 40,000 divided by weight, that is at 100,000 capital requirement level. When that capital requirement is exceeding 100,000. So that is marginal cost of capital. So as every point where the break point is arise, your weighted average cost of capital is changing. So then you can identify marginal cost of capital. When the Haludin stock issue, what is the cost? So that is we call MCC, marginal cost of capital. Now, so here the company has retained earnings 40,000 rupees, which can be financed the portion of the 100,000 to be raised. Since APC desired capital structure 40% common equity, so at that point, company issue new equities. So when the total capital requirement is exceeding 100,000, you have to issue new shares. So that is where the first break point is arise. Within up to this 11.64 is over. So So when you total capital requirement exceeding the 100,000, you can see weighted average cost of capital is changing. So you can work out this marginal cost of capital. So likewise in this line, there will be a 100, 200 breakpoints throughout this line. Right? This is not a fixed number. This is a dynamic number. This is changing. Yeah, we may calculate using the existing capital. They may cost like a venas with the market situation. Right? When the cost of capital component cost is changing, that is changing. You have to identify MCC. When a breakpoint is arise, that is changing. And only one breakpoint. There will be another. There will be another based on the debt capital limit. So now let's see how to determine MCC and the weighted average cost of capital. Same example. Are you okay? I think after this calculation you will realize, right? I am explaining this MCC concept. ABC decide to raise additional capital of rupees 100,000, making total increase from 100,000 to 200,000. It is clear now. Existing total capital is 100,000, so they are raising additional 100. So now total capital is 200,000. Compute weighted average cost of capital at which they can raise this amount. Right. So now I think this is clear. You may recall the example. Existing capital structure with the 100,000, retained earning 40,000, weights 40 on debt, 40 on equity, 20 on preference shares. So now they are raising additional 100,000. So what is the for this additional 100,000? Now you can calculate. You can see the example. So this is the weighted average cost of capital. Back. So this is for the first 100,000. When the total capital requirement is 100,000, your weighted average cost of capital was 11.64. You already did it. You have calculated. Now, when the total capital now 200,000, the additional 100,000 are raised. You raise additional 100,000. So now your total capital is 200,000. So how you finance this 200,000? This is the new capital 200,000. So how do you finance this 200,000? Are we changing our capital structure weights? No. This is same. Weight is not changing. 40% say debt. 40% equity, 20% preference shares. This is our desired capital structure. Make a venas in there. This is our optimal capital structure. This is not changing. So how this 200,000 is financing? From the 200,000, 40 means 80,000. From the debt, how much you are financing? It is 40% weight, 80,000. So you will get from the debt capital 80,000. This is 80,000. Then equity also 80,000. Equity also 80,000. Here 40,000 from the preference shares. This is way of financing. The ඉස්සල්ලා අපි ලක්ෂයෙන් finance කරගත්තේ කොහොමද? 40 from debt, 40 from equity, 20 from preference shares. Now your total capital is 200,000. So now 80 from equity, 80 from debt, 40,000 from the preference shares. Now this 80,000, others are not issued. This 80,000 total equity capital portion is 80,000. How this 80,000 is calculated? How this 80,000 is, what are from which you get this 80,000? This 80,000 represent 40,000 internal equity, 40,000 new stock issue. And the is the retained earnings zero. In your company, you have 40,000 retained earnings. So this 80,000 equity portion, you are financing how? 40,000 you are getting from retained earnings, 40,000 you finance from new stock issue. So now this 40% weight is divided between internal equity and external equity. From the total 40 means then you may better to listen that one because this is how to calculate. From this 80, now this is the equity part now 80,000. So this 80,000 how we are going to finance? 40,000 from the retained earnings, 40,000 from the external or the new stock issue. Then from the 200,000, 40,000 means what is the weight? Then when the deduction got thought, other is the retained earnings 20%. So then this 40% is divided 20 from retained earnings and 20 from retained earnings, another 20 from new stock issue. So this is your weighted average cost of capital. This is how your 200,000 total capital you have been financed. So if you look at here, this is weight on the retained earnings. RE retained earnings. Weight is 20%. 20% into cost of retained earnings. Plus weight on new stock issue. 20%. Weight then cost of new stock issue is given in the question 17%. Plus others are not changing. Weight on the debt capital 40. After tax cost of debt. Weight on the equity 20%. Cost of equity. So this is your new weighted average cost of capital. This is the cost of weighted average cost of capital for the 200,000 total capital requirement. This is weighted average cost of capital, not the MCC. This is weighted average cost of capital if your capital requirement is 100,000. Lakshana capital, this is your cost of capital. If your total capital requirement is increases to the 200,000, this is weighted average cost of capital. Now from here to here, you have raised how much additionally? Make a deduction, but additional 100,000. So what is the MCC? MCC is cost related to this increase of the capital. Now here from 100,000 to 200,000, you have changed the capital. So additionally, you have raised 100,000. Right? So what is the MCC? Marginal cost of capital is the weighted average cost of capital of new capital issue. Now here there is a new stock issue. There is a new stock issue with this requirement. So then what is the MCC? You can see for this 100,000 MCC and the VAT both are same. For the next 100,000, now additional 100,000 you raise now. Your MCC is, this is not changing, this is not changing, but here new cost component or new cost is coming because that is the cost of new stock issue, 17% into 40%. So this is marginal cost of capital. If you are going to issue, if you are going to raise additional capital, so this is the cost. Now, this is MCC. Lakse rupiya වැඩි කරන්න ගියොත් this is the cost. If you increase this 100,000 by 50,000, this is the relevant cost. This is LCC. But however, when you 50,000 is extra, when you add the 50,000 your total capital, how this total capital is financed like this. Retained earnings there, either 40 from retained earnings, 20 from retained earnings, 20 from new stock issue. But if you have to raise new capital, additional new capital, this is the relevant case, relevant cost. So that is we call marginal cost of capital. If you look at this table further, you can see up to 100,000. This is both are same. Back MCC both are same. From 100 to 200,000, when you increase your total capital with additional 100,000, so now this is the MCC. For the additional 100,000, your MCC is 12.04. Again, then stock, fund raise this is relevant to your relevant cost. The existing capital structure, if you calculate weighted average cost of capital, so this is the new weighted average cost of capital. Right? So this is MCC, this is weighted average cost. It is difficult to understand. MCC means, now in this example, this is your total capital, 100,000. Right? If you are going to increase this 100,000 by some amount, your retained earnings is not sufficient. Retained earnings you have only 40,000. So then you have to issue new shares in order to keep the 40% capital structure for equity. So then if you are issuing new shares, you have to have cost for the new stock issue. You can see 17%. New stock issue cost is 17%. So that is related to the new fundraising. If you are going to increase total capital from 100,000 to 101 rupee, this is applicable cost. Cost. So that is the weighted average cost of capital. So this is how you finance the total 200,000. When you are raising, when your total capital requirement is 200,000, 40,000 coming from retained earnings, 40,000 coming from new stock issue. So this is weighted average cost of capital. The total capital like finance. So this is related to the additional fund raising. So if you are increasing the additional funds, this is the MCC. If you project in the salary, so this is very relevant. If a project you should compare with this. If you have investment, you can fundraise. A project that is not fair. So the project IRR should compare with this MCC, marginal cost of capital. Because we are raising additional 100,000 for this project, for this investment. So this investment IRR should compare with marginal cost of capital. This is the two concepts, MCC and the marginal cost of capital. If you go to the definition again, MCC, this is MCC. Is the weighted average cost of capital of the next pure capital raise. If I increase in additional capital, what is the cost? That is MCC. Right? It is the marginal cost of capital. Right? In this
Excuse me, miss.
Yes.
Miss, එතකොට අපි මේ එතකොට MCC කම්පියුට් කරද්දී equity capital එකත් වෙනස් equity capital එකෙන්ද fund කරන්න පුළුවන් debt capital එකකින් fund කරන්න පුළුවන්ද?
But in this question you are not given any information regarding the debt constraint.
Okay.
This question you can finance the debt capital at the available cost, whatever the amount. But if you are given in the question up to 500,000, this is the cost. Next 500,000, this is the cost. So when you are raising your debt capital, so you have to consider that. And also you can calculate breakpoint using the debt capital.
Okay, thank you, Miss. Okay, thank you.
Same you can apply for the preference shares also. So you will have breakpoints, million dollars someone later. Throughout this weighted average cost of capital, you will have different breakpoints. When the component cost of capital is changing, there will be a breakpoint. So then line like jump here. So likewise, you will have a breakpoints. When the cost is decreasing, there will be a decreasing of the cost. So this is the advanced area of the cost of capital. You just learned what is cost of capital, how to determine it, what is the weighted average cost of capital and MCC. From this point onwards, there is the advanced areas. So we can apply this thing for the investment evaluation. Now if you look at this diagram, same thing you can see. This is weighted average cost of capital. This is MCC. MCC is greater than the weighted average cost of capital. Why? What is the reason here? When you raise for the capital requirement here 200,000, you have financed only the 20% from new stock issue. There was a retained earnings at the lower cost. So therefore your WACC is normally lower than the new stock issue. The top rate point net capital cost plus. This is the end of the cost of capital. Do you have any question? We have a few questions to discuss and then we can go to the capital budgeting. Look at the importance of this. I think I explained this thing. No need to again to say. This is the importance of the cost of capital as a benchmark in financial management decision, especially in the investment decision. To take the investment decision, you should know what is MCC. When you are struggling, when you are going to take the additional investment, new investment, you should calculate MCC relevant for this particular investment. Then it is the rate for analysis of the investment project. This is the required rate of return for the investors of the company. As I mentioned here, this is the minimum rate of return required on new investment. So this is the importance of cost of capital. It's a benchmark for the financial management decision. It is the discount rate when you calculate the NPV, profitability index. This is the required rate of return from your investor. We are calculating from that point. So this is minimum required rate of return you should secure from your investment. Right. So this is the end of the cost of capital. So now you can see I have put some extra sections from the tutorial. Do all, but anyway, let's look at this one. Can you see this? This is in your tutorial also. Do you have any question? Any clarification on the cost of capital? MCC ano iba? Mother wala ke. Iba ke gaana ke na this is MCC calculation haji. Yes.
Yeah, excuse me, Miss. Do we need to separate this asset beta and equity beta?
I didn't get asset beta.
Yeah, equity beta. Like when we compute in the equity return by using CAMPM model.
But we discuss only the capital. This is fully based on the equity beta. Equity beta. No need to confuse with the asset beta. I think some of you asked the same thing. Gearing and non-gearing. This is not relevant to here. Don't make confused with the asset beta. This is only based on the market portfolio and based on the equity beta.
Okay, Miss. Thank you.
Any question? So we'll do this question. JNPSA capital structure based on the market value. Based on the market value, you are given. It is considered to be optimal. Now, in the previous example, you may observe that capital structure is not changing. Even though you raise additional 100,000, your capital structure is same. It's not changing. It is your desired capital structure. It is the optimal one. It is remain constant. So, you are extra additional stock issue. Right, you are given capital structure. This is considered to be optimal. Market value based given. Debt 30 million, equity 30 million. During this year, company plans to raise 30 million and invest in new projects. Company can issue new unredeemable bonds, have coupon rate of 8% at par. Right? They can issue unredeemable mean perpetual bonds. No maturity. At par mean at the par value at 1,000. JPSC's common stock is currently selling for 30 rupees per share, and the required rate of return for the shareholders estimated to be 12%. Dividends are expected to grow at a constant rate of 8% per annum, definitely. The next dividend expected to be 1.20 rupees per common shares. Next dividend. Corporate tax rate is 30%. Assume that flotation cost of issuing new shares is 10%. You are asking to do what is the existing weighted average cost of capital of the company in order to maintain the current capital structure. How much of the new investment requirement must be financed from equity? In the part B above, how much is the cost of new fund raise? How much is the new weighted average cost of capital related to the previous discussion? This is for your previous paper, I think. Huh? One of your paper, I think. So this is connected to the discussion we did just now. So now, nothing difficult, right? Just take the information. You may take the information separately. All are there. Cost of debt you can calculate. Cost of equity you can calculate. Capital structure information is given for the debt and equity. So nothing is difficult. Try to do. Right, we'll do this. So now, first, what is the existing weighted average cost of capital of the company? So in order to calculate the existing weighted average cost of capital, you should know weight on debt capital, weight on equity capital, cost of debt, cost of equity. Do this. So total capital is 60 million here. This is 60. I'm writing on the same price. So then weight on debt 50, weight on equity 50. 60 million, 60, 30 million from the debt capital, 30 from the equity. So the weights are 50% from debt, 50% from equity. These are the weights, 50, 50. Right. So now you should know what is the cost of equity. What are the information given to estimate the cost of equity? Company, now you can look at this one, right? It may be better to understand this. Company can issue new unredeemable or unredeemable bonds that have a coupon rate 8% at par. What is the hint included here to identify the cost of debt? cost of debt. Yes, cost of debt related to the, now there is a bond story of million bank loans remain with the bond no any bank loans, so you have to consider the bond here. So there is a hint given to identify the cost of debt. What is that? But it said if you are issuing new unredeemable bonds today, you can issue at a coupon rate of 8% at par. I mean at the 1,000. At a coupon rate of 8%. So this 8% representing what? If you are issuing new bond issue today, this 8% coupon you determine by looking at the ongoing interest rate today, by looking at the market today and the future expectation. So likewise, as analyzing the existing situation. So this 8% represent what? What is this 8%? Cost of debt. Then after the make it there is a bond issued 5 years ago, coupon rate is 8%. Can you take this 8% as the cost of debt? Because that bond was issued 5 years ago. Either 5 years ago issued and 8% money cycle. So that is past. It is some time back. But this, if you are issuing bonds today, you can take 8% as the coupon rate. That is very related to the ongoing market expectation. Even at the bond issue, market expectation coupon rate we are going to do a new stock issue. You have to determine coupon rate very similar, very close to the existing market interest rate. Otherwise, investors may not. So then, but this is the hint given for the cost of debt identification. Nothing any calculation. No any calculation. Just you can take this information, this 8% as the cost of debt. Coupon rate 8% this is the new bond issue. If you are going to do a new bond issue, non-redeemable one, the possible or the appropriate coupon rate is 8%. It is given. Alutin bond issue market so therefore we are taking this as a existing ongoing interest rate. So nothing to calculate here. Cost of debt is 8% before tax, right? KD. Cost of debt is 8% before tax. This is before tax. Cost of equity. How much the cost of equity? What are the information? Common stocks currently selling at 30 rupees per share and required rate of return common shareholders estimated to be 12%. Dividends are expected to grow at a constant rate 8% per annum indefinitely. Next dividend is expected to be 1.20 rupees per share. What is the cost of equity? Cost of equity is? This is given no. And required rate of return for common shareholders is estimated to be 12%. So that is the cost of equity. And with an additional information, dividend growth model dividends for the next calculation. So cost of equity is KE is 12%. So how much the existing weighted average cost of capital? Nothing here. Existing weighted average cost of capital is equal. 50-50 is the weight. 8% into this is the before tax one. So you have to consider the tax rate here. tax rate is 30%. So 8 into 1 minus 0.3 into 50 plus 12 into 50. This is the existing weighted average cost of capital. Ne? Again, Part B. In order to maintain the current capital structure, what is the current capital structure? 50 on equity, 50 on debt. How much of the new investment requirement must be financed from the equity capital? There is a new investment requirement. During this year, company planning to raise 30 million for new investment project. In order to maintain current capital structure, 50-50 equity on and debt, how much they should raise from the equity capital? Part B. For the investment new project, they need 30 million. They are going to raise this 30 million for this investment. Part B task, because the existing capital structure is the optimal one. It is the optimal capital structure. So in order to maintain this optimal capital structure, how much they should finance from the equity capital? 15 million. 15 million from equity, 15 million from debt. Right. Part C. In part B above, how much is the cost of new fund raise? So that is actually the marginal cost of capital. How much is the cost of the new fund raise? How much is the new weighted average cost of capital? Tell me what is the existing weighted average cost of capital? What is the answer? 8.8. The existing weighted average cost of capital is 8.8. Right. Now calculate the new one. You can see here, if you are going to issue new shares, there is a flotation cost 10%. If you are going to issue new shares, new stock, new ordinary shares, flotation cost is there 10%. So now you have to identify new cost of equity. Because now extra 15 million you have to raise from the equity, 15 from the debt. Debt capital, in related to the debt capital, you are not given any constraint. So the same cost of debt you can use for the additional 15 million also. So then new cost of equity is how much? New cost of equity, say KE is equal the with the given information, which model you have to use? Dividend growth model. So according to the dividend growth model, cost of equity is equal D1 divided by flotation cost adjusted price plus growth rate. Next dividend expected to be 1.20. Next dividend is D0 or D1. D1. Next dividend expected to be 120, so you can take here 1.2. Price. Currently, stocks are trading at 30 rupees. So price is 30. Flotation cost is 10%. 0.1 plus dividends are expected to grow at a constant rate at 8%. So this is the new cost of equity. This is the new cost of equity. Cost of issuing new shares. How much the new cost of equity? 12.4. It is 12.4. Cost of debt is not changing. You can use the same number. So now calculate marginal cost of capital and new weighted average cost of capital. Marginal cost of capital or the cost of new fund raise or the MCC is equal. MCC is equal. If you are issuing new funds or if you are issuing new shares, the cost is 12.4. So 12.4 into 50 plus debt capital is 8, no? 8 after tax 1.8 into 50. This is the marginal cost of capital. Here you have to use new cost of new stock issue 12.4. ඒක විතරයි වෙනස් උනේ මෙතන. Debt capital 8% same. Start changing. So therefore you have to take this here. The MCC is how much? Thank you, sir. Considering also MCC is say 9%. This is 9%. This is 9%. New weighted average cost of capital. So this is existing weighted average cost of capital. So new weighted average cost of capital is equal. Now you have raised additional 30. Now your total capital is how much? 90 million. 60 million already there. Additional 30 you raised. So now it is 90 million. So 90 million is coming how? 45 from debt. 45 from 45 from debt. 45 from equity. This is debt. So debt වෙනසක් that cost is 8% by. So here this 45 equity. So additional raising only 15 million. There may 45 and 30 at 12%. 12%. 15 at 12.4. $45 in 30 and 90 in the rate. From this 45, 30 from the 30 at the cost of 12%, 15 new issue from quantities at the 12.4. The 90, 30 mean what is the weight? Do it here. So this is the total capital. Capital is 30 million and 20% on the weight is 33. The weight is here 33. The may follow the balance. It is 33%. 16.6. This is 16.6. Right. So new weighted average cost of capital is equal. Weight is 33. 33. Cost of 12 plus 16.6 at the cost of 12.4 plus debt capital is 8%. After tax rate is 30. Weight is 50, has another. Right? That's what I'm doing. 50. 33. The total is 90 million. 33 weight equity is coming at the cost of 12%. 16% weight equity is coming at the new cost, 12.4%. Balance 50% coming at the 8% cost. So this is the new weighted average cost of capital. What's the new WACC? New WACC is how much? This is how this 19 million are financing. What was the from equity 50, debt 50, 50-50. Equity 50 calendar may equity 50 only 30% at the cost of 12%, 16% at the cost of 12.4. Stock issue. So then how much will be the cost? $13. So this is the new WACC, new weighted average cost of capital. Project now you are raised this additional capital for the new project. So this project item you should compare with this NCC. Then अभी मैं project additional capital should raise 15-30 million. The project proper evaluation of the project. This project IRR should compare with this 9% than the weighted average cost of capital. Other than the 13%. $13%, the 8 point. First, this is 9%. 9% make argument no. Yes. MCC is 9%. Argument theoretical. 13 point sorry. Exactly what is the new weighted average cost of capital? All right. This is 8.8. So please you will be able to manage this type of question. You can do this one by yourself, right? This is based on the balance sheet information by identifying the capital structure. You can calculate later. මේ වගේ questions දෙකක් හොඳට බලා ගන්න ඔය දෙකෙන් එකක් විභාගෙට අහන්න කරපු දෙයක්. ඊට අමතරව you may look at your tutorial and final until last ආගේ index නම් එක ගන්න. Other questions you may try out. This level by expectation. I think you can manage it. No problem. So shall we move to the budget? Break එක දුන්නම වෙන්නේ නැහැ. But continue කරන්න පුළුවන් ඉතින් maximum 15 minutes. You need break, otherwise I will do something else. Coordinate චතුරනේ coordinate කරන්නේ චතුරයි. Continue. Right. You need a break. You have the break at 3:45 minutes. I can help you. You take a break, you can go take 15 minutes. Follow it. You can follow it. it's you know that long term, normally it is investment beyond a year, long term. So here we are going to evaluate actually capital. When we say the capital budgeting, it is very vast area. We discuss again very basic fundamental level introduction to the capital budgeting. So this is very important. This is related to the investment decision because value creation, value maximization will impact on this investment decision. So you are raising capital. In the previous lecture, we identify cost of raising funds, cost of capital. So this use raised funds now we are using in the projects, in the investment. So that is what we are going to do here. If you look at the diagram. Remember, this was in your first lecture, in the introduction. So you can see our decisions, financing, investments. So if you look at here, this is fundraising from the capital. So we estimated cost of capital here, cost of raising capital, cost of capital. So then this raised funds you are investing here in the projects, in the investment. From the investment, you are generating some return. So we call it the rate of return or the return. So there is the cost of raising funds. There is the return from the investment. So this is very important things to maximize value, maximize return. So normally the internal or the rate of return generated from the investment should be greater than this one. Otherwise, you may not be able to create value for the business, value for the owners. So you can see our decisions actually we discussed capital structure, sorry, cost of capital. Now this is related to the investment project for the investment decisions evaluation. So we are on this process. We are on this that role of financial manager, this one. So these are interrelated, not isolated. You cannot discuss. These are related. Whatever the things you do here is affecting to here, and ultimately for the this one also reinvestment and return to the share investors all are affected. So this is a big picture, right? So now let's look at the objectives. At the end of this session, as I say, capital budgeting is very vast area, very complicated. Most important decisions that financial manager should have to take. So, but here our focus more towards on this aspect. You will learn what is capital budgeting and its importance. We will identify different type of investment projects, and our more focus on this using certain techniques like discounted and non-discounted techniques. We are going to evaluate the project to see whether they are acceptable or not. So mostly we are on this area throughout this session. Right, so let's see what is capital budgeting. When we say the capital budgeting, it is not the overnight decision. You can see, you look at the, I have uploaded some reading chapters based on this PowerPoint. PowerPoint is prepared based on that chapter. So capital budgeting is the decision-making process. Right? It is a decision-making process for accepting or rejecting a long-term investment. When we say the investment here, it is always long-term. Long-term means go beyond the accounting period or the accounting year or financial year. So whatever the impact of this decision will get the company for long period, more than 1 year. So that is why we call it as an investment decision. Return or the impact will receive into the company for long period. So this capital budgeting is a decision-making process because it involves certain steps. When you are taking the long-term investment decision, there are certain steps. Now, if you take a financial manager, So first, you have to look at the different alternatives. You have to select the feasible investment. So then you have to forecast the cash flow. You have to estimate the cost of capital of the project. So having read the project, time to time you have to present the project to the board of directors prior to approval. So likewise, then you have to get the approval. So then you have to look back again the process. So likewise, this is a long process. Sometimes it takes 6 months, like more than even 6 months to finalize particular investment. Because it involves large amount of investment, not like investing 100,000, 200,000. It is a million, billion, large amount of investment here when we say the capital budget. But we discussed the concept by using very small project. But when we say the capital budgeting, it's a large amount of investment. The company risk is affected largely with this investment project. So therefore, this is very carefully. Financial manager should take this decision very carefully because it's affecting the risk, growth, and the going concern. So this is very important one for the company. Right. So this capital budgeting decisions is the most complex, most complicated, most complex decision facing by the management. Because of that, because it involves current funds for the future benefits. If you look at the reading textbooks of these Pandas textbooks, these are explaining very nicely. Because you exchange the current funds for future benefits, your return will be, you will get after 10 years, 5 years. So that is after long period. So this is very risky, complex, complicated decision. You exchange current funds, you are investing today. Your return is after 5 years. You have to wait long period. And also funds are invested in the long-term assets. Same thing. You are investing in the long-term assets. So return or the impact of these assets, company is receiving for a long period. So we are investing in the long-term asset, not the current asset. This is on long-term assets. And funds, future benefits will occur from over many years. Again, time. So your benefits you will get for 10 years, 20 years, 15 years, or likewise for the long period. So therefore, this capital budgeting decisions is very complex. You know that when you have to deal with the future, there is uncertainty. There is a possibility to happen in certain things. Your decisions purely based on the forecasted things. So your forecasted things can be worst, can be go to the wrong. So then if you'll have to have alternative. We call the real option of the project. So likewise, this is very complicated, complex area in the financial management. But here you will learn what is capital budgeting, what are the different types of process, how to evaluate the project using NPV, IRR, and like that. But that's not the capital budget. We just fundamentals, conceptual things we discuss here. But if you are going to more, it's like a separate topic, separate discipline, long-term investment evaluation. So it's a very big area. Like you can see importance of the capital budgeting. You can discuss on these aspects: growth, risk, funding, reversibility, complexity. So I request you to read this text material I uploaded, this section. I have here only the bullet form, but anyway, this section, the importance of the capital budgeting, they have that textbook explaining elaborately. So you better to read growth. This is affecting to the growth of the company. Growth depends on earning, value creation, earnings, long-term survival. So likewise, growth is affected by certain factors. So the long-term investment decisions directly connected with the growth. Because if this project is success, value will increase. Market price of the share will increase. Shareholders will maximize their return. So growth is connected all these things. So therefore, this capital budgeting decisions is a growth-oriented one. So ultimately, when you are evaluating decision of this capital budgeting investment, you may look at the NPV. NPV is still the superior method of evaluating projects. So based on the NPV, you see whether you are getting value creation or value destroyed. If you invested in the value created projects, the growth of the company will increase. So normally growth will increase when the value is created. So this is growth area. So that chapter is explaining this thing very simply. You better to read. Other thing is the risk. You know that we are invested for the long term, for a future. So you know that risk. When you have to wait long period to get the return, what happens to the risk? Increase. Risk is increasing. So you know what is happening when the risk is increasing. When the risk is increasing, investors' required rate of return is increasing, cost of capital is increasing, so value is affected. There is a trade-off between risk and return. So you should have to properly manage this. This is affecting to the risk factor of the company. Risk factor of the company purely depends on long-term investment. Long-term investment. If companies are doing good, value creating, secured investment, investors may attractive, investors may perceive this as a riskless company. So their required return will affect according to the risk level. So likewise, totally risk factor depends on the long-term investment. You know that when we say the risk, now it is a very broad concept. You cannot define risk like this. We calculate a risk using the standard deviation, variation, systematic risk, or systematic. That is not the risk. Risk is mean business risk, financial risk, total risk. You know that how to impact the business risk, how the financial risk impact with the long-term investment project. So with the capital structure, I don't know whether time is permit for me. We can identify this business risk and financial risk, leverage, degree of operating risk, degree of financial risk, we can calculate. So that is directly affected with the risk factor of the company. When the risk is impacting, value is affecting, so ultimately affecting the even growth rate. Funding, like I mentioned, this is a large investment. Billion investment. Large amount of funds you are investing for the future benefits. Large amount of funds. So that is affecting to the cash flow of the business. That is affecting the cash flow of the business. So when you are investing large amount of funds, immediately your investors or the shareholders may go out of from your company sometime. Because by the investment of the large amount of funds, they may perceive this as a risky investment. In the short run, you may have what we call the liquidity issue, cash management problem, because large amount of investment. You are getting return, say after 10 years, 5 years. So immediately, sometimes you can see in the marketplace when you agreed or when you entered into a large amount of investment, sometimes immediately in the short run, your share prices is decreased. In the marketplace, there is a decline in the share price. Because some investors going away from the company because that company invested large amount of money, so there is a going concern problem, cash flow problem will arise. So therefore, immediately some investors are going. They are we call technical investors. There are two investors, technical investors and fundamentals. So technical investors immediately going away and they are investing in another company because they are trying to get short-term return to get maximize their gain. But fundamental investors, they are investing in the kind of things. They are looking at the long run, long term. So we call passive and active investors, same term. But anyway, funding is mean we are investing large amount of fund. So this is risky. This is risky. If that expected return, if not generated from this particular investment, vulnerable. We are in the distress, financial distress, bankrupt. And the other thing is the irreversibility. You know that when it's come to the capital budgeting decision, certain steps are there. Initially, you identify a proposal, you may present it to the director board, you may get the prior approval, so then you may forecast the expected cash flows of the project. So you may estimate the cost of capital for the project. Then you may evaluate the project based on this cost of capital. Finally, ultimately, you will accept the project. Right? After accepting even, you will go back and you will review all the things again. After accepting, there is a certain cost you cannot recover if you stop the if you reject the particular investment. Cannot reverse. After accepting the long-term investment project, you cannot reverse because large amount of sunk cost is there. There is a sunk cost. Some machineries, equipments you have purchased for this particular project. So you cannot sometimes cannot give this particular investment to another company or another investor because these are very expensive for this particular project. If you decide to reject the project after a certain period of the acceptance, it's a very big cost. So therefore, we identify this capital budgeting decision is not reversible. Not reversible. So therefore, before taking the decision, it takes some 6 months, 1 year, so likewise certain evaluation before finalizing, before taking the final decision. Because of this irreversibility. Large sunk cost, you know what is sunk cost? They are already incurred. They already we spent for this particular project. So we cannot recover if you reject the project. So this last sunk cost you can recover if the project is success only. Right. So therefore, reversibility. Reversibility is another special characteristic of this capital budgeting decisions. You cannot reverse. So therefore, you have to think about all real option. Capital budgeting analysis. So there is a point we call the real option. If you consider like this thing happened, what is the cash flow? If this went like this, what is the possibility? So likewise, all real options possible happenings you have to identify. So it depends on forecasting ability, analysis ability, techniques you are using to evaluate the project. So likewise, this is very, very complicated, big knowledge area. We learn here nothing. Right? So that type of area is the capital budget. I also know it nothing. So that is very complicated area. So you can use the sensitivity analysis, what do you call the Monte Carlo scenario. So likewise, certain analysis are there for evaluating the capital budgeting. It's not like calculating NPV, IRR, and payback. Right? So that's a big area. We learn very few concepts under it. Complexity. Because of the long run, this large amount of funds, all these things make it very complicated, complexity decision. Again, I'm requesting you to read this section in the at least first 2-3 sections in the capital budget is that reading material uploaded one. So these factors are explained. For the exam paper, I would like to ask a question like this. Explain the importance of the capital budgeting decision. So you should be able to at least take in 3 factors from here to explain. Simply not like writing 2 or 3 pages, right? In very precise way, using very simple format, you should be able to explain. Right. So therefore, read because for your paper, not only the calculation, you will have certain theory question. So you better to read that reading chapters to get that knowledge. Okay. Then classifications. So you can see this capital budgeting decisions. You can categorize like expansion project, diversification, replacement, modernization. This is 2 classifications. And also you can categorize mutually exclusive, dependent, independent like project. Expansion. Suppose that currently we producing, say, a particular product. Say we are producing only the garment. So we are expanding our product line to the another particular, say, to produce bags. So that is expansion. Expansion. So existing business, we are expanding to another product line. So that is the capital budgeting decision. Capital budgeting decision. Long-term investment decision. Diversification can be horizontal diversification, vertical diversification. You can diversify into the different industries, or you can diversify with the supplier. You can diversify with the customer. So likewise, diversification. So we are diversifying business to get max return at a minimum risk. So that is the investment decision. I think in the strategic management like subject, you might have learned this diversification related theories. Horizontal, vertical, likewise mergers and acquisition. These are investment decisions. Replacement. Suppose currently our business or product is doing labor-oriented process. We are say we are producing certain material or certain our product using more labors, humans. So we are replacing this one using equipment, machines, computers. So we convert into the capital-intensive process. That is a replacement. Existing machine we are replacing with the new modern developed machines. Replacement. That's the capital budgeting decision. Modernization. You can see some companies, some banks, like if you look at the what do you call this cooperative banks, rural banks. 5 years back, they were very traditional with no any lobby area, no chairs to sit, no waiting areas. It's a very traditional layout. Now, if you look at now, they have modernized. They have layout for the sitting areas, reception is there, lobby areas is there, AC installations are there. So they are modernization. So that is what investment. Even replacement of the AC machine is an investment. Is a modernization coming, which is another investment. So we are expecting certain return by installing this AC machine, by enhancing the customer retention and customer may coming to the particular outlet. Now look at the supermarkets. Look at the queues. Sometimes queues outlet is very small. Parking area is twice bigger than the outlet. Very high, large parking area. So that is the investment. Because it makes easy access to the customers for the outlet. So that way they are trying to enhance the sales, retention, and attraction of the customers. So that is the investment, not just they are investing not for just to that extent. They are trying to get certain return. Large parking slot. So all these things you can identify long-term investment decision like. So this is one classification. This is another classification. Mutually exclusive, independent, or dependent. Dependent or we call contingent. So what is this? Mutually exclusive, independent, and contingent. Mutually exclusive means suppose you are evaluating different projects for same purpose. Same purpose. Mutually exclusive acceptance of one will automatically reject the other. So you are evaluating different projects to achieve same purpose. Suppose that you want to have highly sophisticated modern machine. So you are evaluating 5-3 suppliers. Right? So once you select one particular supplier, so automatically other proposals, other projects are rejected. So that is a mutually exclusive type evaluation. Acceptance one, automatically rejecting the others. So we evaluate this project, same purpose, for the same purpose. Independent means, if you evaluate certain projects for the different purposes, that is we call independent project. Likewise, say Toyota company want to enhance their production by increasing say 50% from the light vehicles, 50% from the heavy vehicles. These are independent. These are independent projects. So their target is increasing more. So this type of projects we call independent. So we evaluate this project for the different purpose. Contingent means, or we call dependent project. Contingent is acceptance one project is dependent upon selection of another. Dependent. So this is a good example for the contingent like this. Suppose like this, a factory of the particular company is going to establish a factory in very remote area. very rural area. So that is the project. So related to this project, there are certain certain supplementary projects to enhance the road, sanitary facilities, electricity, accommodations, foods and beverages. So likewise, certain projects are connecting this main project, like in umbrella. So that is we call contingent type project. So we are not discussing this contingent type project, but we evaluate only the independent and dependent project. So in the contingent type project, like there are connected projects. So we have to look at all these projects. You can see here the choice of one investment necessitated undertaking one or more other investment. For example, developing a factory in a rural area, backward area, may have to invest certain other projects. So when you calculate the NPV of this parent project, you have to look at the cost involved for the other dependent project. So that is a contingent type project. This is very complication of evaluation. So this is one classification: mutual, exclusive, independent, and the dependent. So let's look at the budgeting process. There are many more than this. Different textbooks are explained in a different way, but I have put summarized version of this process. This capital budgeting process, as I mentioned, it is a process, not overnight job, not one what you call the one spot. You can take it one point. This is a process. Cannot do it overnight. So you can see certain steps are there. Estimate cash flows. Then assess the risk of the cash flow. Then estimate the WACC, cost of capital related to the project. Then evaluate the cash flow. So at least you have to follow this system. So if there is the project, so you have to forecast the cash flow. What is the cost? What is expected net cash flow year 1, year 2, year 3, year 4? So likewise, considering all possibilities, happenings, changes in the environment, with the probability distribution, you have to estimate the cash. That's why I mentioned this is very, very complicated. For the estimation with the probabilities and the things, very difficult. So then you have to identify the risk level. Again, this is very complex. How to determine risk appropriately. So based on that risk level, you may identify what is the appropriate cost of capital for evaluating this project. If this particular project, if it is changing average risk level of the company, you cannot use company cost of capital to evaluate the project. Right? That is a different area, right? Normally, company is a portfolio of the investment. Company is an investment. There is a portfolio. Suppose you are taking a particular investment, this project. If this project impact overall risk level of the company, so then it will change the company risk level, company cost of capital. So then you cannot evaluate this project using company cost of capital. So you have to calculate separate cost of capital for this project by considering that particular risk level. If you use the average cost of capital to evaluate this particular project, that is wrong. Another area. So project cost of capital, you have to calculate again by using CAPM, beta coefficient. So there are certain theories, certain areas. So project cost of capital you have to take. But anyway, in your this level, normally we are using company cost of capital to evaluate the project. But anyway, you have to know this one. Always you cannot take company cost of capital to evaluate the project. Separately, you have to estimate cost of capital for the project. I told you that MCC point. Because of the project, if company cost of capital is changing, this overall cost of capital you cannot use to evaluate this particular project. So then you have to identify what is the regular cost of capital for this particular company, particular project. Then we are coming to this point, evaluate. That is more based on this discussion. So we are evaluating using different techniques like NPV, IRR, payback, modified rate of return, profitability index, like pay. So that is how focus more on this discussion. Right. So we go to this process then. First one is estimate of the cash flow. When you are estimating the cash flow for a project, three types of cash flows you have to identify. Right? Three types of cash flow. In simple format, one is the cost of the project, then incremental cash flow throughout the life of the project, and the terminal cash flow. These are the three types of cash flow. So you can see investment cost, initial cash flow of the project, then after tax net operating cash flow over the life of the project. Throughout the life of the project, you have to identify net cash flow after adjusting the tax. Then in the terminal year, separately you have to identify what is the terminal year cash flow. So basically, these three cash flow you have to identify related to a project. Initial cash flow, annual net operating cash flows throughout the project, and terminal year cash flow. So normally, when you estimate the initial year cash flow, cost of the project, suppose this is a new investment, you are investing in the new project. So this is the basic formula for the identification of the initial year cash flow. Initial outlay or the initial cost is equal fixed cost investment plus net working capital change. NWC means net working capital investment or the net working capital change. If it is a new investment, you have to consider the fixed cost related to the project. In addition to that, because of this new investment, you may have to invest on certain current assets. You may have to have some obligations. You may have certain obligations, current obligations. So that is also you have to consider. That is the net working capital investment. Current asset, some current liabilities will arise. Like you have to take certain inventory, raw materials, you have to take a bank overdraft. So certain current working capital related current liabilities, current assets will arise. So that is you have to consider adjustment of the net working capital, investment in net working capital. If it is a new investment, say if it is a replacement, suppose existing project, existing machine, you are replacing with new one. So then you have to consider this part also. If it is a new investment, so there might have a salvage in the existing machine. After depreciating this existing machine, there is a scrap value or the salvage value at the end of the replacement day. So that salvage value you have to consider as a cash. If salvage value, if it is a profit, on that you have to pay tax. So you can see this is the salvage, this is the book value. If there is some profit, on that you have to pay tax. If it is a replacement, so you have to consider this scrap value or the salvage value, and if it is profit, you have to pay tax. So this is the cost or the initial year cash flow if it is a replacement. Right? Salvage, the sales means the cash proceed, salvage value from sale of all fixed capital, tax rate. B0 means that is book value or the book value of the all fixed capital. This is initial year cash flow estimation for the existing, replacement, and the new machine, new project. Then I think that one is explained with this slide. Investment in the net working capital, you can see. Working capital means current asset and current liabilities. Working capital means current asset. Net working capital means difference between current asset and current liability. I think no time to discuss this working capital thing. So normally working capital is, with the investment decision I explained you, working capital pay, fund requirement related to the day-to-day cash obligation. So normally when we say the working capital, this is investment in current asset. Working capital means investment in current asset like cash in hand, bank balance, inventories, short-term investment, receivables. These are the current assets. So net working capital means difference between current asset and current liability. You know what are the current liabilities? Creditors, payables, bank overdraft, short-term loans. So these are the current liabilities. Working capital is the investment in short-term assets required for the investment. With a new project, new investment, certain working capital you might acquire. You might use certain working capital. So you have to consider that. Is the investment of receivables, inventories, and some payables? If you purchase some materials, some machines on credit, there will be some creditors. So payables will occur. You have to consider. So normally this point is important. You should realize this. Increase, decrease in net working capital should be subtracted and added to operating profit. Increase in net working capital mean increase in asset, current asset. So it is a cash outflow. Increase in net working capital mean increase in current assets. So that is a cash outflow. Decrease in working capital mean decrease in current asset. So that is a cash inflow. So therefore, accordingly, you have to adjust increase in the net working capital. Accordingly, you have to subtract and add to the operating profit. With the example, you will realize I have put one example to realize this cash flow estimation. Anyway, if it is an increase of the net working capital, it is outflow. Again, we inventory raw material cash outflow. Decrease in way, creditors are salary hapuna. Obligation then it is a cash inflow. So likewise, you have to adjust the net working capital decrease and increase. So this is initially a cash flow. Then throughout the life of the project, you have to work out cash flow. You have to after tax net operating cash flow over the project. If it is 5 years, you may identify what is the net cash flow over 5 years. The only thing when you calculate in here net cash flow, you know that depreciation is not the cash flow. For the tax purpose, we consider depreciation exactly to calculate the tax amount. After we identifying the net profit, after deducting the depreciation, to calculate the cash flow, you have to add back depreciation. Throughout, this is here net operating cash flow, not the profit. Project we evaluate based on the cash flows, not on the profit. Profit we are evaluating project based on the cash flow. So net operating cash flow. So then you will get the net profit. In the income statement you can calculate net profit. So this net profit you have to add back the depreciation to get the operating cash flow. Because you can see the computation of the after-tax cash flow require careful treatment non-cash expenses such as depreciation. Depreciation is not a cash outflow. In order to identify taxable income correctly, we deduct the depreciation. So after identifying the tax portion, you have to add back the depreciation to get the operating cash flow. You will realize with the example, right? So that is what you have to do throughout the life of the project. You have to adjust this depreciation like non-cash items when you calculate it. Then this is the formula. You can see here. This one. S is the sales minus expenditures minus depreciation. The income statement under the operating expenditures, we deduct the depreciation. So then we calculate after tax profit, you will get the net profit. So we add back depreciation in order to get the cash. Because depreciation is not a cash flow. So here, this is operating cash flow. So you may add back the depreciation to get the cash. So this is normal income statement formula. Sales minus cost minus depreciation. So this is after tax profit. So after tax profit, you have to add back depreciation to get the cash flow. This is again same thing. Right. Then terminal year cash flow. At the end of the project, you have to work out terminal year cash flow. So again, you can see there is some salvage. That value you have to consider it. And now, if you are releasing, if you releasing the net working capital, you have to adjust it. Initially, at the beginning of the project, there was the net working capital requirement. At the terminal year, when you finish the project, now no more requirement of the current assets. So then you have to adjust it. So at the terminal year also, initially at the zero, at the beginning, if there is a net working capital requirement, now you have to release it. Because now project is over. Right? So you can see, so that is you have to adjust here. And then on the salvage, if there is profit, consider it. You have to pay tax. In the terminal year also, annual terminal year, you can work out annual operating cash flow. This annual operating cash flow, you have to adjust for the salvage. If there is a profit on the salvage, you have to pay tax and net working capital adjustment. So this is how to estimate cash flow, initial year cash flow, annual operating cash flow throughout the life of the project, terminal year cash flow. So let's look at this example, very simple example to identify this formula. Consider an investment first that includes, there is an investment or project, first is 400,000 rupees outlay for fixed capital items. This outlay or this outlay being cost includes 25,000 non-depreciable land plus 175,000 equipment. That will be depreciated on straight line basis over 5 years. The project life is 5 years. The project requires 50,000 rupees of current asset. It generates 20,000 current liabilities, resulting in total investment in net working capital 30,000. There is a result net working capital increasing or the investment of 30,000. So each year, sales will be 250,000. Expenditures, operating expenses will be 90,000. Income tax rate is 40%. At the end of year 5, company will sell off the fixed capital asset, including the land, for 50,000. Terminal year, there is a stock value 50,000, including the land. Additionally, the net working capital investment of 30,000 recovered because the short-term assets, short-term liabilities are no longer needed for the project. So you have to release the working capital requirement at the terminal year. So investment project has required rate of return 10%. So what you have to do, determine for this project initial year cash flow for the 5 years, annual after tax operating cash flow for the year 5, terminal year cash flow. So based on this cash flow, we are going to calculate NPV, IRR, payback, everything. So initially, you have to estimate the cash flow. So a cash flow based on the අපි project එකේ evaluate කරන්නේ. You are given here cost of capital is 10%. It is given. Initially, to calculate the net present value, you should know what are the cash flows. So likewise, you have to account this. Just read and see, we'll discuss together. But anyway, it will take 1 minute. So likewise, you have to identify a zero cash flow. 1, 2, 3, 4, 5. 5 years project. Second formula. And the implication on the taxation of the says minus the cost. It completed architects completed one and then depreciation of the same thing. So you can go to the example. Consider investment cost is 200,000. It includes 25,000 non-depreciable land plus equipment 175,000 depreciating over the time on straight line basis. Right. So you can work out initially a cash flow. Okay. That is investment cost is fixed capital cost is 200,000. 200,000. That's net working capital. Project require 50,000 current asset and it generate 20,000 liabilities. So there is a net working capital increase by 30,000. Increase of the net working capital. Current asset value, you know, increase of the net working capital 30,000. So you can see net working capital is 30,000. Increasing net working capital means cash outflow. It's a negative cash flow. Then your zero cash flow is 230,000. This is the initial investment of the project, 230,000. In year 1, year 2, year 3, year 4, 5, cash flows you can estimate. According to the question, you can see every year sales will be 250,000, same amount, so very easy. Expenses will be 90,000 for every year. The tax is 40%. This is salary. So you can consider that one. So every year sales 250, operating expenses 90,000. So here to calculate operating income before tax, we have to consider depreciation. How much the depreciation? Is 200,000 again land 25. So then it is not depreciable. 135,000 straight line basis. So annual depreciation is 35. Yes. Straight line basis over the life of the project. No. So then annual depreciation is 135,000 divided by 5. So your depreciation is 35,000. I think you clear that 35,000 how it comes. Only this one is depreciated. 175,000 divided by 5. Trend line basis. So that is 35,000. So then you can calculate operating income before tax and you can calculate tax, then operating profit after tax, all the things. So you will get operating profit after tax, after the tax rate, it is 75,000. This is important. Now you have to add depreciation 35,000 in order to get the after tax operating cash flow year 1. Depreciation is not a cash item. We deduct the depreciation to work out this. Make a hurry identify the depreciation salary. To work out this taxable income, operating profit before tax. So then you will get the tax 40%, 50,000. So then operating profit after tax is 75,000. So you have to add back depreciation. So this is the after tax operating cash flow. So all 5 years, this is same. It doesn't matter increase or not, income value. So therefore, for 5 years, you will get this is same. Now you have to work out terminal year cash flow. So in the terminal year, that is year 5. Right? So this is the after tax operating cash flow in year 5. So now this is you have to just for the salvage, you have to release the working capital requirement. You have to identify terminal year cash flow. So we'll work out the terminal year after tax non-operating cash flow. Now in the question, it says that at the end of year 5, company will sell off the fixed capital asset, including land, for 50,000. So the value of the land is 25,000. It is not a depreciable one. Right? So how much the profit here? You are getting 50,000 at the end of 5 years. But this includes, you are selling all, including this land. It's not a depreciable one. So then profit is 25,000. Because that equipment is totally depreciated now. I have 35,000 car depreciate. So that equipment is totally depreciated. So then here profit is 50,000 minus this land value. So profit is 25,000. On this profit, you have to pay tax. 25,000 is the profit. On this, you have to pay tax at 40%. On this, you have to pay tax at 40%. So your tax will be 10,000, no? Tax is 10,000. 25,000 into 40, 10,000. So then, after tax, salvage value is 40,000. After tax, salvage value is 40,000. 50,000 minus tax is 10,000. Take operative, they run it. 50,000 or 25,000 land cost is you have to deduct. So on that you have to pay 40% tax. So tax is then 10,000. So after tax salvage is 50 minus 10,000 is 40,000. So then in the question it says this one. Additionally, the net working capital investment 30,000 is recovered. Initially there was a recovery of the net working capital of 30,000. Now project is terminating. So therefore you have to release the net working capital investment. So therefore that is also you have to adjust. So return of the net working capital here 30,000. Increase in mean it is a cash income. So then you will get totally 70,000. So terminal year cash flow is 180,000. So this is the cost of the project. This is the each year net cash inflow. This is the terminal year cash flow. This is the after tax operating cash flow during the 1, 2, 3, 4 years. This is the terminal year cash flow. Any question on this calculation? So here I defined you the different types of cash flows related to this project. Initial year cash flow, net operating profit after tax for the life of the project, and the terminal year cash flow. Based on that formula, we calculate. Any questions and clarifications on this? So now, based on this cash flow, we are evaluating feasibility of the project. Now, using the cost of capital of this project, you can calculate a sheet and see whether this is a value generating project or not. You can calculate IRR. You can calculate PI index. So that is what we are going to do next. All right. Before going to that, you have your tutorial example that is on the cash flow estimation. Look at this one. This one. LNPFC planning on replacing the existing machinery in the production plant. You can visible, no? Right. The company has estimated that the cost of the new machinery will be 4.5 million. $4.5 million, and installation charges will be 500,000. Useful economic life of the machine is 5 years. PLC anticipate the improvement in the production facility with the new equipment will have positive impact on its earnings. As a result of that, after-tax net cash flow, after-tax net cash flow is estimated to increase by 1.5 million on the first year. Thereafter, it will go further 5% per annum. 5% per annum during the remaining life of the new machine. By the end of useful life, economic life, new machinery will be fully depreciated and its residual value will be 750,000. New machinery also has additional net working capital requirement of 800,000, which is required to be made at the beginning of the operation. This net working capital requirement will remain unchanged throughout its life, and the tax rate is 30% and cost of capital is 15%. So you can do this one. Estimate the initial cash flow, annual after tax cash flow from year 1 to year 5, and determine terminal year cash flow. In 5 years, 0, 1, 2. Cost is 4.5 million. It's a set, so the estimated cost of the machine 4.5 million. Additional, there is a net working capital. The machinery also the additional net working capital requirement 800. Installation charges also there, so you have that one also. 500,000 is the installation charges. 500,000. The increase of the net working capital, that is 800. So total cost is how much? 5.8 million. 5.8 million. So then the result of that, this is given after tax net cash flow estimated to increase by 1.5 million. You are given not the profit. In the section it is given after tax net cash flow. Is it adjusted depreciation or not? Depreciation adjusted to nothing. After tax net cash flow. Depreciation adjusted. Okay. No need to add back depreciation again. So after tax net cash flow is 1.5 million. This is 1.5 million, but this is increasing. Thereafter, it will grow by 5% per annum during the remaining life of the new machine. So this 1.5 is increasing by 5%. This is after tax net cash flow. Inflow, outflow को adjust करला, tax का ताड़ू करला, depreciation को देखा तो करला थी. This is after tax net operating cash, not the profit. After tax, अभी तो you are given after tax net operating profit. So what you have to do? You have to add back depreciation in order to convert it into the cash. But here you are given provided after tax net operating cash flow. So no need to do just the depreciation. So but you can work out cash flows here. These are increasing by 5%. So what are the numbers you can work out? 1.5 million into 1.5. So likewise increasing by 5%. These are the cash flows, no? Correct. 1 point. What will make 0 or 0 point? Make 1.5 million with the guarantee. It's by 5%. 1.5 million. 1.5 million increased by 1.5 Then terminal cash flow you can adjust accordingly. By the end of the useful economic life, new machine also has an additional net working capital requirement 800. So now we have to release it. What are the scrap value? New machinery will be fully depreciated. Its residual value is 750,000. Tax rate is 30%. So you have to consider this thing also. There will be a decrease of the net working capital 800. So then this is decreasing mean it is a cash inflow. You have to consider that 800 and also scrap value is 750. So this is totally profit because that that machine is fully depreciated. So this scrap value, residual value is totally profit. So on this 750, 750 you have to pay tax. Tax rate is 30%. Tax rate is 30%. So you have to pay 30% as the 225,000. So after tax salvage value is how much? Salvage value is equal this minus this 525,000. So the terminal clear cash flow is equal this plus increase in the net working capital plus after tax salvage value 6.6 million. Okay, 6.6 correct. 5.3 800,000 decrease of the net working capital you have to consider. Then this is the after tax salvage. So this is the
This growth is 5% or not 50%, no?
This 1.5. This is in is it correct? Email. I share with them. So these are the cash flow cycle. That's all. That's it. That is very easy one. Right. Okay. These are the traveler and can like it. PowerPoint channel. So this is all right. So you can do. So this is estimation of the cash flow. So after that, determine the discounted payback period, profitability index, calculate the net present value. So now you can do this thing because now you have estimated cash flow, cost of capital also given. So now we are going to evaluate the project based on the different techniques. The next part is that. So we are going to evaluate in the project. So basically we consider non-discounted based cash flow method and discounted cash flow based method. Can anyone tell me what is that non-discounted and discounted cash flow based method? Time value adjusted and the time discounted mean time adjusted cash flow based calculation. Non-discounted mean we are not adjusting time value, we are taking the cash flow as it is. So under the non-discounted based cash flow method, you can see payback period is there, accounting rate of return is there. But anyway, this payback you can calculate on discounted cash flow also. On the discounted cash flow based method, we discuss NPV, IRR, and profitability index. So let's start with the payback period. It is very simple method for evaluating the project. Right? Right? This is very simple method to evaluate the project. Payback means simply how many years, number of years you have to wait to recover your initial cost of the project. So that is the payback. The number of years required to recover the initial cost of the project is the payback. Very simple. Even anybody layman can understand this one. This is the payback. If cash flows are equivalent throughout the project, payback period you can calculate using this formula. If there is a equal cash flow, cash inflows in the project. But remember, if cash flows are different, now in our previous example, you cannot apply this because annual after-tax operating cash flows are different. Year 1, year 2, year 3, year 4 different. So you cannot apply this formula. But if there is a equal cash flow, annual cash flow, you can apply this. Initial investment cost divided by annual cash flow. So normally the decision rule, this depends on standard payback. Actually, the standard payback is not theoretical number. Right? The standard payback subjective. It changing from company to company. Normally, financial manager may have some feelings, some gut feelings. Our payback period is 4 years, 5 years. So likewise, they will have a certain idea in their mind. So this is very subjective one. Company to company, industry to industry, type of the project, this standard payback will different. But anyway, you can evaluate your project based on the payback period. If calculated payback is less than the standard payback, you may accept the project. If calculated payback greater than the standard payback, you may reject the project. The standard payback is not theoretical number. This is very subjective perception. Subjective number. It depends on the financial manager's record, company record. Right. When you are comparing two projects using the payback period, remember this. If initial cost of the project, if it is different, suppose you are comparing projects using payback period. If initial cost of the project, if it is different, you cannot apply payback period to evaluate the project. In order to compare two projects based on the payback period, initial cost of the project should be equal. Right? Otherwise, you cannot compare. You can calculate payback, but you cannot compare. This is important, right? To compare two projects using payback period, initial investment should be equivalent, should be same. Right. So this is the payback period. If you look at the characteristics of payback period, this is very simple calculation. Very simple. This provides measure of liquidity. What is the liquidity? Liquidity is cash generating ability of the project. That is the liquidity. Cash generating ability of the project. So this payback period is a measure of liquidity. Suppose there is a two projects, A and B. You have calculated payback. Here, 2.5 years, say 3.5 years, payback period. Which project has high liquidity? Okay. Because the initial cost of the project you can recover within 2.5 years. So that project A has the high liquidity. So therefore, payback period is a measure of liquidity. And also payback period is important as a measure of risk. As a measure of risk. Risk factor. Now, if you look at the same example, which is risky? Project B. Because you have to wait 3.5 years to recover initial cost. So this is risky. This project has high liquidity. So therefore, strength or the good thing, advantage of the payback period, by looking at the payback period, you can have some idea about the liquidity of the project as well as the risk factor of the project. Disadvantages is greater than the advantage, not true measure of profitability. Because when we say the profitability, very simply, profitability is the overall effectiveness of the project. Profitability is the overall effectiveness of the project. Payback say which year you can recover the initial cost of the project. But what happens to this project after the payback period, we don't know. After this payback period, there might have a negative cash flow. So therefore, it doesn't say anything what happens to this project after the payback period. So therefore, by solely based on the payback period, you cannot evaluate project. This is a major limitation of the payback period. It doesn't show overall effectiveness of the project. It not measure of profitability of the project. And other than that, it ignore the cash flows after the payback period. It is also limitation. Even though you calculate discounted payback period, it also ignore the cash flows after the payback period. It ignore the time value of money. But this is not a problem. This is not a problem because you can calculate discounted payback period. By discounting these cash flows based on the cost of capital, discount factor, you can recalculate payback period on the discounted cash flow. So therefore, this will be not a problem. So because of this limitation, you may end up with a decision that not maximize shareholders' credit. But this two limitation is serious. Not the overall profitability. It doesn't show any overall profitability, and also it doesn't say anything about after the payback period cash. Right. So let's calculate payback period quickly for this project before going to home. There is two projects, A and B. Calculate payback period for the project A. You cannot apply formula. You cannot apply formula because you can say annual net cash flows are different. So therefore, manually, you have to work out where the payback period. For the project A, where the payback. Yes, no. Exactly 3 years, 240 plus 60. So this is the payback, year 3. Yes, no payback period. For the project B, 300,000. From 300,000, you can recover year 1, 90,000. To remain 210. Okay, 90,000 you can recover. 200 again, you can recover 90,000. So it remains. Yes, sir. because it is 33. So you can recover 90,000 from the 100 bills, so remains 30,000. In there is the 30,000 from the cost. Take a method in so the payback is years and how many years? 4 months. So you can calculate 3 years, 75,000. 30,000 divided by 75,000. If it is years, 30 divided by 75. 30,000 divided by 75,000. 0.4. So the payback is 3.4 years. Or 3 years and 0.4 into 12. Get it? This is 3.4 years. 4.8. Again, approximately 3 years and 5 months. 3 years and 5 months. This is the payback. Well, if it is a year, 3.4 years. If you convert this 0.4 into months, that is 3 years and 5 months. It is risky. Which has the high liquidity? Good. So the limitation of this time value, ignore that the problem is that it does not consider the time value or the time value or the time value. So that is you can overcome by calculating discounted payback period. Number of years required because this. So you know that this cash flows you have to adjust it for the time value. So then you can calculate payback period again based on the discounted cash flow. So then it does not problem of this limitation. Doesn't consider the time value of money, so that limitation you can recover. But anyway, still it doesn't show the overall effectiveness. It doesn't say anything about the after the payback cash flow. These problems are remains. Right. And form you can calculate this the discounted payback period based on you are given 12% here discount rate for the cost of capital. It is given. So what you have to do, you have to convert. These are the non-discounted cash flows. Right. These are the non-discounted cash flows. So these after converting, after adjusting the time. Right, at the 12%, you know how to adjust the time. So this is now time adjusted cash flow. So based on that, you can